Three stocks tied to the EV boom soared yesterday. General Motors went up 5%, Workhorse went up 8%, and FuelCell went up 28.6%. Let's look at FuelCell a little closer to figure out whether it's a buy or a sell. Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day to 8 a.m. In this video, I am going to walk you through the process of valuing FuelCell stock by analyzing their financial ratios and dissecting their financial statements so we can determine if it's a buy or a sell. FuelCell designs, manufactures, operates, and services direct fuel cell power plants that run on natural gas and biogas. It is the largest publicly traded fuel cell manufacturer in the U.S. The company operates over 50 plants all over the world. It operates the world's largest fuel cell park, located in South Korea. It also operates the largest fuel cell park in North America, that's located in Connecticut. Its customers include utility companies, municipalities, universities, and many more. Let's get started with the model. This is a small cap company, market cap $1.5 billion. They're trading at $5.10 a share, and they have 295 million shares outstanding. Let's look at the financials. The way you value a company, you estimate the future free cash flows, and then you discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they have negative free cash flow in 3 years. Only in 2018 they had a positive $6 million. Net income is the profit and loss on the income statement. It's revenue minus expenses, and they have negative net income every year. Their revenue also looks pretty weak. It's $96 million in 2017, down to $65 million in 2020. So their 2020 revenue is $65 million. The cost of revenue is $87 million. These are the direct costs associated with making a company's products. So its gross profit is negative $23 million. You generally don't want to invest in a company that has a negative gross profit because they still have operating expenses and interest expenses and other expenses. So there's no way they could turn a profit if they have negative gross profit. So as you can see, every year they have negative net income, and it seems to be getting worse. And 80% of the company's revenue is with these 9 companies. You generally don't want revenue that's so concentrated, because if any of these companies stop doing business with you or go bankrupt, that can really affect your top line. Especially ExxonMobil, they do 40% of their business in 2019 with Exxon. And this is the statement of cash flows. And operating cash flow is a better indicator of a company's health than the net income, because operating cash flow takes into account non-cash items. So you can see in 2018, even though they had negative net income, they had positive operating cash flow because they were probably passing through lots of non-cash items. But they did have negative free cash flow in every other year. Plus, this company has capital expenditures, investments in property, plant, and equipment. And the way you calculate free cash flow, it's operating cash flow minus CapEx. So each year they have negative free cash flow, except in 2018 they had positive. Since a company bleeds cash every year, in order to stay in business, they have to issue capital stock. So in 2017 they issued $67 million. This is a combination of common and preferred stock. They issued $35 million in 2018, $43 million in 2019, and $92 million in 2020. They're also issuing a lot of debt every year. You can see $18 million, $13 million, $70 million, $103 million. So the ideal situation for a business is that you would run the business and use all the cash from your sales to pay your expenses and to also pay your investors, not have to borrow with debt and equity. Of course, for startups and businesses that have large one-time expenses like acquisitions, they may need to take out some debt or issue some equity. But on a long-term basis, you don't want to do that every year just to run your business. Let's look at a capital structure. $112 million of debt, $136 million of equity. They pay a high interest rate on their debt, 9.5%. And 45% of the capital structure is debt, which means 55% is equity. The cost of equity is 19.14%. And to calculate cost of equity, we use the capital asset pricing model. And part of the CAPM formula is the beta. That's how volatile the stock is relative to the market. And they have a pretty high beta, 2.19. So the stock moves more than 2 times the market. So it's a pretty volatile stock. The higher the beta, the higher the cost of equity. And their WACC is about 15%, which is a blend of the cost of debt and cost of of equity, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $1.7 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1 billion. We divide that by 295 million shares, and we get a calculated stock price of $347. They're trading at $510, so they're trading at a 47% premium. It's a sell according to the model. Simply Wall Street's a little lower than me. They're at $210 a share, so they're saying the stock is even more overvalued. When you look at the historical stock price, it looks like the stock was trading over $100. But it never was trading over $100. The reason it looks like that is because they did a 1-for-12 reverse stock split in 2015, then another 1-for-12 reverse stock split in 2019. So it is hard to look at this chart to figure out where the stock has been moving. A reverse stock split is a signal of a company in distress. The main reason companies do reverse stock splits is so they don't get delisted. When a stock price is below $1 a share, it gets delisted from a major stock exchange, then it moves on to the pink sheets or over the counter. When a stock moves off the major exchanges, it falls off of investors' radars, and then less investors buy the stock because it's less visible. Because most investors, especially large investors, don't invest in stocks below a certain amount, like below $5 for instance. So this company had two 1-for-12 reverse stock splits, one in December 2015 and one in May 2019. And I just made up these numbers. But say for instance, you held 144 shares in November 2015 and a share price was $1. And if the company did a reverse stock split in December 2015, you would now hold 12 shares that cost $12 each. So it wouldn't change anything. You still have $144 of the company's value. Now say in May 2019, the company did another 1-for-12 reverse stock split. Now you have one share that cost $144. So nothing changed. You still have $144 of value. Of course, this type of scenario would never happen. I'm just giving a really simplified example of two 1-for-12 reverse stock splits. Now this is a type of example that may happen in the market. Say on November 2015 you had 144 shares that cost $1. The following month the company did a 1-for-12 reverse stock split. Now you have 12 shares at $12 each, so nothing changed. You still have $144 of value. But say in April 2019 the stock price was driven down over the past few years to $1. So your 12 shares are now worth $1. So the company does another 1-for-12 reverse stock split just to keep its stock above $1. So now you have one share for $12. So now your investment in this company is $12 when it was originally $144. So you lost a lot of money. If you invested $10,000 into this company 10 years ago, you'd have a little under $300 today. That's a 97% loss. Let's look at the financial ratios. The average PE in the market is 14.7. The median is 14.8. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. Since they have negative net income, they have a negative PE. The average price of sales is 5.5. The median is 2.1. Price of sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. They're at 23.2, so they're doing much worse than the median and average. The average price to book is 4.6. The median is 2.3. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. They're at 11.1, so they're doing a bit worse than the average and median. The average interest coverage ratio is 12.1. The median is 3.8. Interest coverage ratio is EBIT over interest expense. They have negative EBIT, so they have negative interest coverage ratio. EBIT is earnings before interest and taxes, also called operating income on the income statement. Average ROE is 11%. The median is 12%. ROE is net income over equity. They have a negative 80% since they have negative net income. Equity is total assets minus total liabilities on a balance sheet. The average current ratio is 1.8. The median is 1.3. Current ratio is current assets over current liabilities. They're at 1.3, so they can cover their current liabilities without having too much current assets on their balance sheet. And their current assets are $9 million of cash, $11 million of receivables, $57 in inventory, and some other smaller items. The best way to look at ratios to compare them to similar companies, I've done videos on GrafTech International, which is in the same industry as FuelCell. And when you compare them against each other, GrafTech is better in PE and price of sales, but GrafTech has a negative price to book because it has negative equity, so FuelCell is doing better than that category. Both companies are above 1 in current ratio. Both companies are doing terrible in ROE. FuelCell is doing much better in debt compared to GrafTech, and they're both pretty similar in market cap. FuelCell doesn't pay a dividend, but GrafTech pays a small dividend. So to summarize, I have FuelCell trading at a 47% premium, but their ratios and their financials look really bad. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a customized valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.